The stock market uncertainty is increasing, and we hear all kinds of noises from billionaire investors, like Bill Ackman, the notorious billionaire hedge fund manager famous for his market manipulation, is saying the Fed has lost control over inflation and urges Fed to be more aggressive in tightening. Michael Burry, the famous investor that shorted the 2007 financial crisis, is saying we're in the greatest speculative bubble of all time in all things, and believes the mother of all market crashes is coming. While it is impossible to tell who is right or wrong, we probably shouldn't listen to what they say, rather we should watch what they do. And thanks to the public SEC disclosures, we retail investors can peek into those billionaires' actions to try to understand what they really think. So, what are they really doing at the moment? Bill Ackman recently initiated a small short position on the bond market, meaning betting the bond price will go down. The position is around 1 to 2% of his entire portfolio. So in the event of a bond market crash, this position could potentially grow into 10 to 20% of his portfolio. The bond yield is currently at 1.9%, which is much lower than the inflation rate. According to Bill Ackman, he is expecting the bond yield to rise to 4 to 5%. This means the bond price would need to go down substantially in order for the bond yield to go up. Chamath, another billionaire investor, has recently initiated a long-short position. A long-short position is a strategy that you long and short the companies in the same sector at the same time. This strategy works especially well during the market uncertainty periods, because this strategy is non-directional, meaning it doesn't bet the market goes down nor goes up. This is a strategy that protects you from price volatility and decreases risk substantially. Chamath is shorting Apple, Meta, previously Facebook, Netflix, and Amazon, while long on Microsoft and Google at the same time. So it doesn't matter if the stock market crashes or keeps going up, he is protected from losing money, while he is also limited to earning more money. In a bull market, big investors usually don't use this strategy because it limits their upside potential. But now they're using this strategy because they see the likelihood of market crash is higher than it keeps going up. Similarly, Cathie Wood has also initiated a long-short position. She is shorting GM and Ford while long on Tesla. In my view, this is a really smart long-short position because it not only protects her portfolio from the short-term market volatility, but also benefits her portfolio from the long-term innovation company against the traditional company play. Now, what do I mean by that? GM and Ford are traditional car manufacturers that 99% of its revenue comes from non-electric vehicles. So Tesla could potentially take some of their market shares in the coming years, because the consumer is shifting towards electric vehicles. Warren Buffett has once said, when automobile was first introduced in the early 20th century, people were betting all kinds of automobile companies would be successful. But in reality, only few survived and succeeded in the end. The more obvious bet is actually to short the horse-provided companies that have more certainty will die out. So, according to Warren Buffett, betting on which automobile company is going to be successful in the early 1900s is foolish. Instead, you should bet against obsolete businesses that are more certainly will die out due to innovation. So right now, Cathie is doing the same bet against the traditional automobile manufacturers. Ray Dalio, legendary fund manager known for his hedging strategies, such as the all-weather portfolio, is also hedging the US stock market crash by exposing to international stocks, especially in China. Ray Dalio has been advocating for China for a very long time now. He thinks a changing world order is likely to happen with China as the rising power challenging the existing power, the United States. He recently launched his biggest ever China fund in November 2021 that exclusively invests in China. Well, we don't know for sure what will happen, but since Chinese stocks are relatively low valuation as compared with US stocks, and China is planning to lower interest rates in 2022 as opposed to US rising interest rates. So I can understand why many investors find Chinese stocks attractive. Even Charlie Munger, the right-hand man of Warren Buffett, also sees the same opportunity in Chinese stocks. He has been purchasing Alibaba stock for the past few quarters, and now around 25% of his portfolio is in Alibaba stock, which is a significant bet on this. Now, a more conventional way to hedge for the stock market crash is simply holding more cash. In a bull market, usually having 5 to 10% cash in your portfolio is good for buying the dip. But in an uncertain market, having 15 to 20% cash in a portfolio will help you lower your portfolio volatility downwards. Even billionaire Elon Musk has recently sold $16 billion worth of Tesla stocks after he posted this tweet about recession. So he is obviously hedging for the market crash too. Now, despite which methods you will use for hedging the market crash, keep in mind the position size of your hedge is more important. For a riskier hedge like shorting the market, a maximum of 1 to 2% position size is enough. For a less riskier hedge like cash, you could go up to 25% position size. And notice that the large portion of those billionaires' portfolios are still in the market. This is because long-term, more exposure to the market is almost certainly profitable despite the short-term downward trend. I hope you learned something from this video, and please smash the like button if you like such content and subscribe if you haven't already. That's it for today. I hope you stay safe in the market, and I will see you in my next video. Bye!